So you see these private real estate deals pop up everywhere, right? They've got these glossy brochures, these flashy websites, and they're all promising amazing returns. Well, today, we're going to look past all that marketing. We're going to uncover the one number that can literally make or break your entire investment. We're talking about cracking the code that separates a truly fantastic deal from, well, just a really good story. Let's get into it.
This right here, this is the whole mystery we're solving today. It's a huge warning sign. It basically says that the single most attractive number in a deal, that promised return, might be built on a foundation of sand. So, what on earth does this actually mean? And more importantly, how can you spot it before it's too late?
You see a number like this, 15% IRR, and it's the bait. It's designed to hook you. It flashes on your screen, promising this incredible stream of passive income from some apartment building you've probably never even heard of. It's that seductive dream of building wealth with other people's money. But these big, shiny headline numbers, they almost always hide the most critical parts of the story.
Okay, I want you to think of this whole thing as a detective story. You're the detective, and that huge, intimidating investment document, that deal memo, that's your evidence. Your job is to sift through the clues, interrogate the assumptions, and find the truth. And I promise, by the end of this, you're going to have all the tools you need to do exactly that.
Every good detective knows where to start, with the evidence. And in our case, the key piece of evidence is something called the Private Placement Memorandum, or PPM for short. This document is the absolute key to the entire investigation.
The easiest way to think about this is to compare it to the stock market. You know, a legendary investor like Warren Buffett would never buy a stock without reading its prospectus cover to cover. Well, a smart real estate investor has to treat the PPM the same way. It's the blueprint. It has all the clues, all the terms, and, yep, all the risks. It tells you exactly how the deal is built and how and if you're going to get paid.
All right, so now we know where to find the clues. Let's get our financial toolkit ready. We need to get a really solid grasp on the basic math that powers any of these real estate deals. And believe me, these next few concepts are completely non-negotiable. You've got to know them.
First up is the net operating income, or NOI. Just think of it like EBITDA in the corporate world. It cuts through all the noise of financing and taxes and shows you the pure, raw earning power of the property itself. The question it answers is simple. How much cash does this building actually generate from its day-to-day operations? That's your NOI.
Now, the COP rate builds right on top of the NOI. And honestly, this might be one of the most important metrics in all of real estate. It tells you the unlevered return you're getting. In plain English, for every single dollar the property is worth, how many cents of pure profit is it spitting out each year? This is what lets you compare a deal in Arizona to a deal in Texas on a true apples-to-apples basis. It's incredibly powerful.
Let's make this super simple. Say a property is worth $500,000 and its NOI is $50,000 a year. You just divide the income, the NOI, by the value. $50,000 divided by $500,000. That gives you 0.10, which is a 10% cap rate. It means the property is generating a 10% return on its value before you factor in any mortgage payments.
Okay, detective. Now for the interrogation. We've got our tools, NOI, and cap rates. Now we can start to poke some serious holes in the story the deal sponsor is trying to sell us. And the most critical, and often the most manipulated, assumption we need to attack is something called the exit cap rate.
This is the multi-million-dollar question right here. The entire projected profit, that juicy 15% IRR we saw at the beginning, so often it all comes down to a single number. The price the sponsor assumes they can sell the property for 5 or 7 or 10 years from now. But what happens if that assumption is dead wrong?
And this slide brings us right back to our original mystery. The sponsor is projecting they can sell this thing at a 4% exit cap. That means the next buyer will only get a 4% return. But hold on. Current interest rates are at 8%. So why in the world would any sane investor buy a risky apartment building for a 4% return when they could get double that from a much safer government bond? The answer is, they wouldn't. This projection is a massive flashing red flag.
So here's this crucial relationship you've got to understand. It's an inverse relationship. When interest rates go up, it gets more expensive for the next person to borrow money to buy this property from you. And to make up for that higher cost, that future buyer is going to demand a higher return. In other words, a higher cap rate. And just remember our formula. If the NOI is fixed, a higher cap rate mathematically forces a lower sale price. There's no way around it.
Now this table shows you the real damage. Let's use our same $50,000 NOI example.
At the sponsor's super rosy 4% exit cap, the building sells for $1.25 million. Great, high profits for everybody. But look what happens if a more realistic 6% cap rate is used. The sale price drops to just over $830,000. And what if the exit cap has to match today's 8% interest rates? Well, the sale price plummets to $625,000, which would likely wipe out every last penny of investor profit. A tiny change in this one assumption can absolutely decimate your returns.
So it's not just about if the deal makes money. It's about who gets paid and, crucially, in what order. This whole process is called the waterfall, and you absolutely need to know how it flows before you even think about investing.
To get our heads around the waterfall, let's borrow an idea from the stock market. Preferred shares. You know how a preferred stock pays a fixed dividend to its holders before the common shareholders see a dime? Well, a real estate preferred return works the same way. It's a promise that the passive investors, that's you, get paid your minimum return first before the sponsor, the person running the deal, gets to share in the big profits.
But, and this is a huge but, this is where you have to read the fine print. You have to know if your preferred return is cumulative or non-cumulative. If it's cumulative, it means any shortfall one year gets added to what you're owed the next. You'll eventually get paid everything you were promised. But if it's non-cumulative, that is a massive red flag. It means if the property has a bad year and can't pay you, that money is just gone forever. You never get it back.
So this is what the full payment sequence looks like. First, and this is the most important part, all investors get their original money back, 100% of it. Second, investors get paid their full cumulative preferred return. It's only after you've been made whole on both of those things that the sponsor gets their share, usually through a catch-up and then a final split of what's left. The whole structure is designed to align incentives and make sure you get paid before they do.
Okay, we've decoded the memo, we've stress-tested the math, and we've followed the money. Now it's time for the brutal truths. These are the risks that are often buried deep in the fine print or just glossed over in the sales pitch.
Let's be perfectly 100% clear about this. Once your money goes into one of these private real estate deals, you cannot get it out whenever you want. This is not a stock you can just sell tomorrow. Why? Because your money is literally tied up in the bricks and mortar of the building. It's been used to buy it, to renovate it, to operate it. As one source put it, liquidity is often missing when it is needed the most.
This timeline really shows what illiquid means in the real world. You're signing up for a 5, 7, maybe even a 10-year commitment. Your capital is completely locked in place for that entire time. There is no emergency exit hatch if you suddenly need that cash.
And now we come to what is arguably the single biggest unspoken risk of them all, the capital call. If the property gets into trouble, let's say they can't refinance their loan at a decent rate, the sponsor can turn around and legally demand more money from you. And if you can't or won't write another check, the fine print often says they can wipe out your entire initial investment. And this isn't just some theoretical risk, not with what some are calling the $1.8 trillion wall of maturity of commercial debt that has to be refinanced at today's much, much higher interest rates.
So here it is, your practical, actionable, red flag checklist. These are the exact questions you need to be asking about any deal that comes across your desk. Think of it as your detective's field guide. Is that exit cap rate way lower than current interest rates? Is the preferred return non-cumulative? Are you really, truly prepared for a 5 to 7 year illiquid period? And do you have cash sitting on the sidelines for a potential capital call? Running a deal through this checklist will expose its weaknesses and save you from just buying a good story.
In the end, it all comes down to this single question. The glossy marketing materials, the slick presentations, they're all designed to sell you a compelling story. A story of easy, passive wealth. But now, you have the tools to look past that story and actually analyze the investment. You know how to read the evidence, you know how to interrogate the assumptions, and you know how to follow the money. So, what are you going to do? The choice is yours.